Good morning. This is Andy Cates from the Global Economics Department at UBS. Sadly, there's been no let-up overnight in the wave of pessimism that's been sweeping around global markets concerning the outlook for the world economy. Asia's equity markets have slumped again, led by a big fall in the Nikkei, and weighed down in particular by news from Sony that it was downgrading its profit outlook by 40%. That Toyota and Samsung have chimed in with some profit gloom as well. Sony has blamed some of this on the recent strength in the value of the yen, so it won't be happy, therefore, to see that the yen has continued to rally overnight, and rally hard, as it benefits from its perceived safe haven status amidst a generic rise in risk aversion. Concerns about hedge funds, meanwhile, remain high, with the prophet of doom, Nouriel Roubini, warning in London last night that panic over hedge funds could actually close markets for up to 2 weeks, and that systemic risk is likely to only get bigger and bigger. Continued declines in commodity prices, the enormous pressures in the emerging bloc, and ongoing pressures on carry trades are only adding to the sense of concern here. As regards the emerging bloc, note that the market's attention is increasingly turning to Russia after a UK Telegraph article noted that credit default spreads for Russian bonds had blowed out to levels that are higher than Iceland's debt before it sought a rescue from the IMF. With the focus of markets, though, very firmly on the outlook for global growth, today's smattering of European and US economic data may well, for once, raise a few eyebrows. Europe sees, for example, the latest raft of purchasing manager surveys, probably the best forward-looking indicators in the economic library, and which we think, sadly, will continue to signal economic contraction, and if anything, print on the weak side of consensus. A survey of purchasing managers that's taken in the midst of the worst global financial crisis that anyone can probably recall is unlikely to suggest a modest 1-point drop in confidence, which is what's presently implied by the consensus. The last 3 weeks of data that have been published in the US, incidentally, has seen 90% of data releases for economic activity print below consensus forecasts, with many of these confined naturally to things like consumer confidence and business confidence. Seems little reason to imagine that today's smattering of business confidence data from Europe would be any different. Elsewhere in the UK, today's first estimate of GDP for the third quarter is expected to shrink by a couple of tenths, the first quarterly contraction in the economy since the early 1990s, and one that will undoubtedly mark the onset of recession in the eyes of many, not least the Bank of England. Finally, as regards data watching, note that the September estimate of US existing home sales is on offer, with a consensus for the record that's centered on a gain of about 0.8% on the month, though our US team is expecting something a bit firmer. That's all for today. Thanks very much.